Hey, I want to talk to y'all real quick about mutual funds. And think of mutual funds as pooled money to purchase pools of investments. For example, let's say I wanted to buy one share in a large company like GE at $30 a share. Or I could purchase one share of a mutual fund that owns shares of lots of large companies like GE, Microsoft, Walmart, etc. So with mutual funds, you're actually diversifying and sharing in the earnings of more than one company. It could be lots of large companies or lots of different companies, right? So I'm gonna give you a quick story. Let's say my goal is to reach the penthouse, right? And in order to reach the penthouse, I must take an elevator to get there. Now, in order for that elevator to move, it must have a cable. So think of that one investment as one cable. As I move up towards the penthouse, I get bad news. And the bad news is that that cable is fraying, or that cable begins to fray, right? So that's going to impact how my elevator move up towards the penthouse. So the opportunity is not good for me to make it to the penthouse in that particular elevator. Now, diversification. Let's say a mutual fund has or is lots of different companies with, in the elevator scenario, it's an elevator with lots of different cables. Okay, so let's just say we got cables that are stocks, cables that are bonds, cables that are commodities, cables that are real estate, and so on and so forth, right? So on my way up, I get that bad news that one cable begins to fray. Or let's just say one company is not doing so well that year, it's having a bad year, right? So it frays a little bit. I still have a bunch of other cables supporting me that are still strong. Okay, so with diversification or with mutual funds, you actually have other companies that help pull you up to the penthouse. All right, I hope that helped.